And actually, I'm understanding this a lot clearer, and so I really appreciate that. Thank you. And I'm just so happy because the explanation is so clear. And my old mentor, it was horrendous, but it just so happens that this situation, it just seems it's so easy of a concept. And in the past, I struggled for 2 years and failed. But now I feel like I'm in a better position with what you're explaining to me. I really, truly understand it. Wow.
I'm very happy to hear that. But never make a decision based on money alone. Like, for example, let's say, other than GameStop, let's say you're trading at a stock that you're looking at a stock that you usually trade, and you say, okay, if it goes over 100, I'm going to get in because I think it could keep going up. And then for some reason you stop looking at it and you don't see it for a couple of days, and then you check it, and then you see the stock's at 110. You're like, oh my God, I knew it was gonna do that. And then you're mad because you missed out on something that you thought was gonna happen. And then the way that harms us is because you think, oh, if I put in X amount of money, I would have made 5,000. I should have, would have, could have made 5,000. So that fear of missing out feels as though we lost $5,000. Does that make sense? And that makes us make stupid decisions with revenge trading and stuff like that.
Right. Okay. Every time people have FOMO, you're always upset over, it's like a revenge feeling. But I don't need revenge. There's nothing to fight for.
Exactly. But that's easier said than done. Sometimes as humans, we will get emotional. It's just in our nature, right? When we're sitting behind the screen and we're reviewing and we're creating a plan, we're thinking logically. That's good. But when the market's open and then we're sitting watching the prices move and then we're creating plans and then we miss something, it might not affect us, but if we're not careful, sooner or later, missing out, it might hit us hard. So that's why we always have to be alert and thinking, how do I feel? And if you ever feel like, oh, fear of missing out is, or any type of fear is about to consume you, just walk away. Don't even look at the trades, don't even look at the market, because you need to address how you're feeling mentally, emotionally, before you enter a trade, before you even think about investing or putting $1.
Okay, do you always have to have a plan before you start trading, no matter what? Your plan needs to be set up no matter what, so that that reduces emotion. If you don't have a trade plan, don't trade.
100%. 100%. Because your plan is like a map, right? And when you're trading and you want to get consistent and you want to get profitable, that's basically the island. And if you want to get to the island, you need the map. And your plan is the map that's going to get you there. But if you go on the boat with no plan, with no map, you're going to get lost in the sea.
Right, you're lost. Okay. So you're lost in the middle of nowhere, right? With no clue.
And even worse, you're lost in something that's so huge as the stock market. It's going to consume you. Just like how the ocean is so huge, the market is also very, very huge and deep, and it can just consume you very easily. But if you have a plan, you're going to get there safely, because the market can't harm you if you protect yourself the right way. But if you're not protecting yourself, if you think about it, you're actually the one that's harming yourself, because the market doesn't even know that we exist, has no idea we're here. Whether we have $100 or 1,000 or 100,000 or even 1,000,000, right? Unless you have billions and trillions of dollars, the market doesn't even know you're there, right? And even if you do have a lot of money, the market can still get you, right? But if I risk very little and my psychology is always right and I control my greed, or my reaction to my greed, I should say, because as humans, it's very natural to get greedy and fear and feel fear. So it's not about controlling the emotion, because the emotion is always going to come. But what we can control is our reaction to it and our preparation to it, right? So always hold on to that plan and understand that once, it only takes one time of you going in the ocean with no plan, with no map, to get lost. One time. It's over. That's it.
Right, one time.
One time
and then you're done.
You're done. Right? Because think about it, especially if you're doing options, right? Options, because of the time value, you can lose all your money in 1 day, 1 minute, 1 second. Like, so that map, that plan has to always be there. Every single trade, every single time that you are looking to enter the market. The market is the ocean. Every single time the market is the ocean. So don't go into the ocean without a map. Doesn't make sense.
So it's the same concept. So when you're driving, you follow the GPS, and then you get there safely. So if you have no GPS, back when I was born, and we had no GPS or iPhones, so it was the hard way with MapQuest. And you had to follow those instructions. It was frustrating to get there, but thank God for technology. We have the iPhone and Google Maps and GPS and all that. We get there safely and on time. And it, in the old days, in the old-fashioned ways, you had those big maps you had to hold out and just try to figure out which way it was right, and then find your destination that way. It's the same thing, right?
Exactly. So imagine you didn't have MapQuest, or you didn't have an iPhone, or you didn't have those maps. You're gonna get lost. You are not gonna get home that day, right? And in the market, that is the equivalent of just losing all your money, and then that's it. Bye bye, game over. And if you want to be in this game long term, every single day you gotta enter it with a map, with a plan, with a game plan, right? And basically, what's
beautiful. I understand. Okay, and so leaving money on the table and FOMO, I understand both of those clearly. Thank you.
You're welcome.
I'm happy, that we're I'm on the same page with you.
Perfect. And I got a question for you. What would basically be in the game plan? What's in the map? As a trader, what's in our map? What should be included in our map? In our plan? That's my question to you. Yeah.
Okay, for the game, entry, stop and loss, profit target, and before entry trade. Oh, and closing, right? Game plan, entry, stop loss, profit target, and close before the trade. Those things.
Good job.
Am I right?
Perfect. Entry, stop loss, profit target, and one last one. Also, remember to write this down also. Max loss. Remember how much you're going to lose on that trade. That's very, very important.
You're right. Okay.
That's actually the most important part. Don't forget that one.
I'm going to type that. Hold on.
Yes.
And this is the interpreter speaking while she's typing. We're going to go ahead and transfer to another interpreter. They've been listening, so they're ready. Okay?
Awesome.
Thank you.
Thanks.
And the max losses. So those are the 4, right?
Yes. Entry, stop loss, profit target, max loss. Yeah. Your entry is where you're going to. Yeah. Your entry is where you're going to enter the stock. Your stop loss is where you're going to get out for a loss. Your profit target is where you're going to get out for a win. And then your max loss is how much money are you going to lose when the stock hits your stop loss. You understand all of that, right?
Okay, so the first thing is I am always going to have a game plan before I start trading, no matter what, period, every time. And so, for example, let's say if Twitter, we're speaking of, or Netflix. I'm horrible with Netflix. It's been horrific. Now Google. Let's talk about Google. Maybe that's a little bit better. But when I'm looking and I decide on the entry and money starts going up, and then a stop loss is when it's going down, right? It's when it's going down.
Stop loss
That's when
is
you
stop loss is where you want to sell if it goes against you. So for example, if you enter Google at, let's say, a price of, I don't know how much Google's going for, but let's say 600, for example. If Google's at 600 and you're entering Google a share, right? So do you know how much Google's going for? I don't usually look at Google.
I really just go ahead and go with a fake figure. No worries.
Okay. So let's say it's going for 600. Now, whether you're buying the call option or you're buying the share, you're not going to hold it until it goes to zero, right? You're not going to hold it until it goes to 300 or 200.
Right.
So you need to know where you're going to sell. So is it 590? Is it 595, 580? So you need to know, where does Google have to go for you to get out of the trade, to just leave, right? And that's what the stop loss is. And then the max loss is how much you're going to lose.
Okay, so for example, if it's at 600 and it goes down to 590, that's when I'm going to leave, or is that when I wait and stay? Which one? Am I going to leave at that target, or am I the 590 from 600?
And again, this is like this fictitious number, like fake number, right? Just like to give you the idea of it. 600 is, let's say that's an entry. You feel like you want to enter at 600 because you see your strategy there, right? Your stop loss is going to be where your strategy is not there anymore. So if you're entering because of a major level at 600, now you have to tell yourself, okay, I could be wrong. Where would I be wrong here, right? Because it's okay to be wrong, but you don't want to stay wrong. You don't want to keep holding the loss and then let the loss get bigger and bigger and bigger. So the stop loss is the price on the chart where you're going to cut your loss. Does that make sense? So that's what you have to determine. It's my stop.
So that's a short term, it's not a long term loss, of course, but you're accepting that short term loss and that risk, and that's the risk that you're willing to take, right?
Right. Whether it's short term or long term, that's up to you, right? And it also depends when the stop loss hits. The stop loss can hit the next day, it can hit the next week, the next month. It depends on how far your stop loss is. But it's up to you to determine where that stop loss is. But what's important is that you need to have one. That is the most important thing as a trader, your stop loss. The price where you're going to exit the trade for a loss. Because if you don't control your loss, you're done.
Okay, thank you. That the term, I like the term exit. Perfect. So that will help me understand it better. So you're exiting at that number.
Exactly. The stop loss is where you're exiting, and it's in the word, stop loss. The stop loss is where you stop your loss. Right?
Okay, let me type this down real quick. One moment. Yeah, I got it.
Right?
I got it. Go ahead and continue.
So the stop loss, again, is where you stop your loss. Because you don't want your loss to keep going. You want to say, the loss, stop. Right? The loss is gonna stop here. Right? It's gonna stop at this price. Right? It's gonna stop when I'm down $100 or $200. So you need to make that match. And then there's a risk management formula if you're trading options, there's a risk management formula that makes it equal, where you lose your max loss when your stop loss on the chart hits. So there's a way to determine that. How many contracts do I buy? How many shares do I
So
buy?
there's two different things. It's the stop loss and the max loss that are involved in that. That's a little bit tricky in the formula. So what's the difference between the stop loss and the max loss?
Great question. Great question. So the max loss is how much money. Yeah.
1 second,
Yeah,
sorry.
take your time.
Okay, continue.
So the stop loss is let's start with the max loss. The maximum loss is how much money you're gonna lose. Money. But the stop loss is where the stock has to go for you to exit. So for example, let's say I'm going to enter Google here at $600 and I'm going to have a stop loss of $590, right? So here, stop loss is $590. And what's your max loss? Give me an example of how much you want to lose on a one trade.
Let's say 200.
Cool. So here, $200 is your max loss, and then your stop loss is where you're going to sell. So you're going to sell at $590. So now the question is, how many shares do I buy? So the way that you figure that out is that you do max loss divided by how far your stop is, right? Your risk. And basically your risk is the difference between your entry and your stop loss. So if you're entering at 600 and your stop loss is 590, what's your risk? Dollar wise, what's the difference?
Math is horrendous. So 600 and then 590.
Yeah, what's the difference between that?
Max loss is 200 and we divide it by 600, right? Is that what it is?
200? No, we're dividing it by the difference between 600 and 900 and 590. The difference.
Okay. So the 590 minus 200, right?
No. The difference between this. The difference between this and this.
Okay. $10.
Exactly. So 200, your max loss, divided by the risk on the chart, right? And the risk on the chart is basically how far your stop loss is. So 200 divided by 10, and then that is 20. So you can buy 20 shares at 600. So if you buy 20 shares at 600 and then you sell them at 590, you're getting out at your stop loss and you're gonna lose the $200 perfectly at the same time. Does that make sense?
Okay, I get it. And just to let, the interpreter's signing is good, but go ahead, sorry.
Let's do another example. Let's say your max loss is 150 and your stop loss is 200.
Stop loss is 200. And then what's my entry price?
230. So
okay, so my entry is 230, my stop loss is 200, so that means a risk of $30.
yes. And my max loss is what
So
here?
that, it's 150, which would be divided by 30, correct?
Yes. So that means that I can buy 5 shares. Because 150 divided by 30 is 5. So if I buy 5 shares at 230 and then I divide it by, and then I hold the shares all the way to 200, I'll lose $150, which is my max loss. I'm good with that. And then also I'm getting out at my predetermined stop loss, a price where I said I'm exiting. Does that make sense?
Okay, so I make a determination of my max loss and my stop. That's my own decision, or is there like a common sense that you know all this before you even enter?
The max loss should always be the same on every single trade, 2% of your account. And then the stop loss is you're always looking at the chart for that. The stop loss is where if you're entering for a certain reason, your stop loss should be where that reason isn't there anymore.
Okay, so I was unaware that the stop loss, you have to look at the chart, and then the max loss is how much you're earning. That's 2% for the account. So that's 2, right?
It's not what you're earning, it's what you're risking. So 2% of your account. So if you have 10,000 in your account, for example, your max loss, preferably, the golden rule is 2%. So 2% of 10,000 is 200. So you want to keep that consistent. Risk 200 every single trade. Most amateurs, sometimes they risk 200, sometimes they risk 500, sometimes they risk 1,000, sometimes they risk 50. So they keep changing the risk. You want the risk to be the same. And your stop loss, you get better.
Okay, so the 2% stable every trade, no matter what, is going to be your percentage of risk, right?
Exactly. 2% of your account, right? Not the fact that the stock has to go down to 2%. It has nothing to do with what the stock does. With what the stock is doing, you're putting a stop loss on the chart. So for example, if you're entering here because of like a moving average, for example, your stop loss, if you put your stop loss here, that's no good because it's still above the moving average. It's still above the level. So you want to put your stop loss a good distance away where the reason you entered is not there anymore, right? And the more you use on demand and the more you practice the chart and go over that, you'll be able to place better stop losses, right? It's just about repetition and just seeing how the stock ends up moving after, right? Does that make sense?
Okay, yes, that is very clear for me. Thank you.